In the past decade, the financial world has witnessed a revolutionary shift with the emergence and rapid evolution of cryptocurrency. From being a niche concept understood only by a few tech-savvy enthusiasts to becoming a global financial phenomenon, cryptocurrency has changed how we think about money, transactions, and even the very nature of trust in financial systems. This essay explores what cryptocurrency is, its origins, how it works, its advantages and disadvantages, and its potential future impact on the global economy. What is cryptocurrency? Cryptocurrency is a form of digital or virtual currency that uses cryptography for security. Unlike traditional currencies issued by governments, known as fiat money, cryptocurrencies operate on decentralized networks based on blockchain technology, a distributed ledger enforced by a network of computers, also known as nodes. This decentralization removes the need for intermediaries like banks or governments, which are typically involved in verifying and processing financial transactions. Bitcoin, the first and most well-known cryptocurrency, was introduced in 2009 by an anonymous person or group using the pseudonym Satoshi Nakamoto. Since then, thousands of alternative cryptocurrencies, often called altcoins, have been created, including Ethereum, Litecoin, Ripple, XRP, and many more, each with unique features and purposes. How does cryptocurrency work? At the heart of most cryptocurrencies is blockchain technology. A blockchain is a public ledger that records all transactions made with a particular cryptocurrency. Each block in the chain contains a number of transactions, and once a block is completed, it is added to the chain in a linear chronological order. To ensure the integrity of the data, cryptocurrencies use complex mathematical algorithms and consensus mechanisms like proof of work, POW, or proof of stake, POS. In POW, miners solve complex math problems to validate transactions and add new blocks to the blockchain. This process requires significant computational power and energy. In contrast, POS allows users to validate transactions and create new blocks based on the number of coins they hold and are willing to stake as collateral. Cryptocurrency transactions are recorded with public and private keys. The public key is like an address that others use to send you crypto, while the private key is your password to access and manage your funds. Losing the private key can mean losing access to your cryptocurrency forever. Advantages of cryptocurrency: decentralization and transparency. One of the biggest advantages of cryptocurrency is that it is not controlled by any single authority. Transactions are transparent and recorded on a public ledger, reducing the risk of fraud and corruption. Lower transaction fees. Traditional financial systems often involve multiple intermediaries, each taking a cut. Cryptocurrency transactions typically have lower fees, especially for international payments. Financial inclusion. Cryptocurrencies can offer access to financial services for the unbanked or underbanked populations in developing countries who lack access to traditional banking infrastructure. Speed and accessibility. Transactions can be completed quickly, often within minutes, regardless of where the sender or recipient is in the world. Unlike banks, cryptocurrency markets are open 24/7. Security and privacy. With proper precautions, cryptocurrencies can offer a high level of security. Transactions are pseudonymous, providing privacy while still being traceable if needed. Disadvantages and risks. Volatility. Cryptocurrency prices are highly volatile. A coin's value can surge or crash dramatically within a short period. This makes them risky as a store of value or medium of exchange. Regulatory uncertainty. Many governments are still grappling with how to regulate cryptocurrencies. Legal restrictions vary widely across countries, leading to confusion and potential legal risks for users. Environmental concerns. Mining, particularly with POW systems like Bitcoin, consumes vast amounts of electricity, raising serious environmental concerns. Scams and fraud. The rise of cryptocurrency has also led to an increase in scams, fraudulent initial coin offerings, ICOs, and cyber attacks on exchanges and wallets. Lack of consumer protections. Unlike traditional banks, crypto transactions are irreversible. If you send money to the wrong address or get scammed, there's usually no way to recover your funds. The role of cryptocurrency in the global economy. Cryptocurrencies are increasingly being integrated into the global financial system. Some businesses accept crypto as payment, while others use blockchain for supply chain tracking and smart contracts. Major financial institutions and governments are exploring the development of central bank digital currencies, CBDCs, to offer a digital version of their national currencies. In countries facing economic instability, hyperinflation, or strict capital controls, cryptocurrencies have become an alternative way for citizens to preserve their wealth or send money across borders. However, this can challenge government control over monetary policy and fiscal regulation. Cryptocurrency also plays a growing role in decentralized finance, DeFi, a system where financial services like lending, borrowing, and trading are carried out on decentralized platforms without intermediaries. DeFi has the potential to democratize finance, but it also brings new risks and vulnerabilities. The future of cryptocurrency. The future of cryptocurrency is both promising and uncertain. Some experts believe that cryptocurrencies will eventually become mainstream, coexisting with fiat currencies and integrated into everyday financial systems. Others warn that unless properly regulated, they could contribute to economic instability and crime. Technological advancements like Layer 2 scaling solutions, cross-chain interoperability, and eco-friendly consensus mechanisms are being developed to address current limitations. At the same time, ongoing debates about privacy, regulation, taxation, and consumer protection will shape the landscape in the coming years. As more people become educated about cryptocurrencies and blockchain technology, adoption may grow. Still, the challenge lies in balancing innovation with safety, openness with regulation, and freedom with accountability. Conclusion. Cryptocurrency represents a groundbreaking shift in how we understand money and financial systems. It offers a vision of a decentralized, transparent, and accessible financial future. Yet, it also brings significant challenges and uncertainties that cannot be ignored. As we move forward into this new era of digital finance, careful consideration, responsible innovation, and collaborative global efforts will be essential in unlocking the full potential of cryptocurrency while minimizing its risks. Whether it becomes the new standard or remains a speculative asset class, cryptocurrency has undoubtedly left a lasting mark on the world economy.